I want you to imagine two scenarios. Scenario number one is, let's say your brother comes to your bank and wants a loan. Everything is legit about your brother. I mean, he has a good job, he's making good amount of money and he's qualified to get the loan. But he applies the loan through you and you confirm it and everything is good. But do you feel like people outside, like maybe your colleagues or other clients, may think that, hey, it's not fair. Maybe Nav didn't thoroughly investigate and explored everything, every documents that his brother had. Maybe he took easy on him. This is conflicts of interest. People may think you have interest in this loan, so you didn't do your job very good. Or scenario number two, there are two products. You have a client, there are two products. Product one is a good product that matches a client, but gives you a lower commission. Product B is, again, good product, matches your client, but gives you more commission. Okay? Which product would you recommend to your client? The one with a lower commission or higher commission? This, again, you have an interest in this transaction. This is conflicts of interest. You don't know what to do. I mean, after this lecture, of course, you would know, and I think you already know that you always need to act in the best interest of your client. You shouldn't think about yourself. In this lecture, let's dive deeper into concept of conflicts of interest, into different types of conflicts of interest, and how to manage when you face a conflict of interest. Let's get it done. Conflicts of interest. We talked about it, but in this lecture, we're gonna dive into details of conflicts of interest, the broad categorization, the common types and examples, and what should you do as a mutual fund sales rep when you face a conflicts of interest, and other details. So this is very important lecture. In general, in the financial world, conflicts of interest happen when an advisor's personal gain might affect the advice they give you, they give the client. There are three big or broad categorization of conflicts of interest. We have existing conflict, we have potential conflict, and we have perceived conflict. Let's define each of these with an example. Starting off with existing conflict. Existing conflict is a real conflict based on something you are currently doing. Let's elaborate with an example. You are a financial advisor recommending an investment fund to a client, but that fund pays you a big bonus for selling it. This situation creates a conflict because you might push the fund for personal gain instead of what's best for the client. So this is existing conflict. We are encountering and facing this conflict right now based on the moment, this situation, okay? The second one is potential conflict. Potential conflict, in the potential conflict, no issues appear right now, okay? But a conflict could arise later. What's the example? Let's say you're advising a client about buying a startup's stock, okay? This is a small startup. And you are considering get a job at that startup. Now, if you take the job later, it could look like you were trying to boost the stock for personal benefit because you are now employee of that startup and you have a big investor here, which you directed to buy that stock. This is, potential conflict of interest. This might happen in the future. The third one is perceived conflict. What does it mean? There is no actual conflict in perceived conflict, but it appears suspicious to others. What's the example? Let's say your friend or family member applies for a loan at the bank, okay? And you approve it. Even if you followed all the rules and if the your family or friend qualify for that loan, people might think you were biased, okay? You didn't review all the documents, you were nice to them. This is exactly the example of perceived conflict. Okay, we broadly categorized conflicts of interest into three types: existing, potential, and perceived. Now, let's get to common conflicts of interest that happens for you as a mutual fund sales rep. Number one, selling your firm's own products. What does it mean? This conflicts of interest happens if your bank, if the organization, the financial institution that you work for offers its own investment funds. So that bank may push you as a mutual fund sales rep to sell their product instead of better options. Okay. Let's say you work at XYZ Bank and that bank offer their own mutual funds. You might feel pressured to sell those funds instead of better ones from another company. This is exactly when selling your firm's own products leads to conflicts of interest. What's the solution here? What can you do when you face this type of common conflict of interest? You recommend what's best for the client, even if it's not your firm's product. The second common type of conflict of interest is compensation-related conflict. What does it mean? Some products pay higher commissions than others, tempting advisors like you to sell them more. Okay? Let's say product A pays you a big commission, while product B, which is a better fit for the client, pays you less. You might feel pressure to sell product A for a bigger paycheck, but you shouldn't do that. What should you do? You should always choose the product that benefits the client most, not you. Great. The third common type of conflict of interest is referral and service arrangements. What does it mean? Some firms pay referral fees for sending clients their way. Okay. For example, your firm offers a bonus if you refer clients to a specific insurance company. But that insurance company's policies might not be the best fit for your client and for everyone. This is when this type of conflict of interest arises. Okay, what's the solution? You should be transparent with your client about any referral fees. Okay, and remember, only refer them if it's truly the best option. Okay. Uh, let's say your client is Mr. John, okay? And you are referring Mr. John to an mortgage specialist, a great one. But that mortgage specialist pays you a referral fee, okay? Or pays your firm a referral fee. And you know that that mortgage specialist is great at what he's doing and it's a great fit to your client. But you should be transparent. You should say to Mr. John or your client that, hey, I am getting this much referral fee and I am referring you to Mr. X. Okay. But remember that Mr. X is great at what he's doing. So be transparent when you face referral and service arrangement type of conflicts of interest. The fourth common type of conflict of interest is having another job or business. What does it mean? If you work another job or run a business, it might affect how you treat clients. So this arise another conflict of interest. Let's elaborate with an example. Let's say you are a financial advisor, but also a real estate agent. Okay. A client asks for investment advice and you push them to buy a house instead of stocks because it benefits you more. This is exactly when having another job or business type of conflict of interest arises. What's the solution here when you face this type? You should tell your firm about another job. Okay. You cannot sneak around and don't tell your firm. You have to tell your firm that, hey, I do have another job. And make sure your advice is unbiased. Okay. You may be a financial advisor and you may be a great realtor. Okay. But you have to be transparent both to your firm and to your client. Okay. Never lie. Never sneak around. And the last common type of conflict of interest is gifts and perks from clients. Are you allowed to get gifts from clients? Let's see that. So, receiving gifts or perks from clients might influence your decisions. For example, a client gives you an expensive gift, let's say a watch, $1,000 watch, to thank you for your service. Later, they ask for a risky investment and you feel pressure to agree because they were generous before. Okay. You may feel like, okay, you owe them because they gave you a gift. So this influenced your decision and how you treat your client. You need to avoid it. What's the solution? You need to follow your firm's rules on accepting gifts and never let gifts influence your financial advice. In most of financial firms, you are not allowed to get gifts more than X amount. That X is a little amount, like 300K, for example. $300, not 300K, $300. For example, a hat, a cheap hat, a $10 hat is fine in some financial institutions. Remember, each financial institution and each firm have their own policies and rules, and you need to follow your firm's rules about receiving gifts. But remember, all of firms and all of financial institutions do not allow you to get expensive gifts. Now, we covered different broad categorization of conflicts of interest. There were three. And then we talked about common types of conflicts of interest and solutions when you face them. But in general, but you, as a great mutual fund dealing representative, you have a general responsibility when you are facing conflicts of interest or when you feel that there is a conflict of interest when dealing with your client. What should you do and what you shouldn't do? Okay. You must identify existing and potential and perceived conflict of interest. Okay. You must identify the conflict of interest. Then you must report serious conflicts to your firm immediately. If you have, for example, another job, this was one of the common type of conflicts of interest. You must seriously and you must report your firm immediately, or other types of interest. Any serious one, actually, all of your conflicts of interest, you must immediately report it to your firm. Then the third step is you need to fix conflicts in a way that protects the client's best interest. Okay? Always clients come first. You have to fix the conflicts of interest to the best interest of your client. And if you can't fix it, you need to avoid conflict. completely avoid it. And we will get to this fixing and avoiding soon. Okay, just bear with me. These were the steps that you need to take when you face conflicts of interest. But what are those things? What are the don'ts? What are those things that you shouldn't do? Okay. You cannot trade or give advice unless the conflict is properly handled and actually your firm has approved it. Okay. So before that, the conflict is properly handled and before your firm's approval, you cannot give any advice or execute any trade. Remember this. This is very important. Now, we talked about different aspects of conflicts of interest. It is time to get into the approaches of handling conflicts of interest. There are three broad approaches: avoidance, control, and disclosure. Okay. So, what's avoidance? Let's elaborate with an example. If a conflict is too serious and cannot be managed fairly, you must avoid it completely. Okay, let's elaborate with an example. Let's say you work at a bank and you own shares in a company. Your client wants to invest in that company. Okay, that company is a small startup that you own, let's say, 40% of that startup. Okay, to avoid bias, you should not advise them on it. You cannot say to your client, hey, I own this 40% of shares of this small startup. You advise your client that, hey, invest your money in that startup's stock. You cannot do that. It's a biased advice. What should you do? You need to avoid it completely. How can you avoid? You say no to the deal. Okay, you stop selling that product or that service and you pass the client to someone else. These are three ways to avoid that conflict when happens. Okay, you say no to that deal, you stop selling that product, and you pass the client to someone else. The second approach of handling conflicts of interest is control. What does it mean? If you can't avoid a conflict of interest, you must control it by using clear policies and rules. Okay? Some conflicts of interest can't be avoided. What's the example? Let's say your company offers bonuses for selling certain products. This creates a conflict. We talked about it because you might push the product for money rather than what's best for the client. Okay. In these situations, you need to control the conflicts of interest. How do you control? You have clear rules to ensure fair advice. You train employees, your bank need to train employees on ethics. Your bank needs to use approval system before making recommendations. These are how to control the conflicts of interest. For those conflicts of interest that cannot be avoided. The third approach of handling conflicts of interest is disclosure. What's disclosure? If a conflict still exists, you must tell your client about it so they can make an informed decision. Okay. For example, you own a tax firm out of your firm, out of the bank. Okay, you have another job which is a tax firm, and you refer your financial clients to your tax firm out of that bank. You must tell clients that you will profit from this referral. Be transparent and clear with your clients. So this is exactly disclosure approach. Okay. let's say you work at a bank, okay? And Mr. John is your old client. And Mr. John trusts you. You are a good advisor, okay? And you also have another tax firm, tax filling out firm outside the bank. Mr. John asks you that, hey, Nav, I want to file my tax and I need help. Do you know somebody who could help me here? Here you disclose that, hey, Mr. John, actually have another tax firm. I can help. But remember, I work here at the bank. You are my client. You're my customer. I need to disclose that. And I'm disclosing it to you. You need to decide if you want to work with me outside the bank or not. Okay. This is exactly what disclosing approach mean. So, what to disclose? Disclose? What to disclose? Explain the conflict in simple terms. Okay. You tell them how it might impact them. Give them time to decide. You cannot say to Mr. John that, hey, decide right now. You have 3 seconds. Three, two, one, go. No, just ask Mr. John, go home and think about it. If you find another tax firm, it's totally fine. Okay. Just give him a time to decide. Great. I'll see you in the next lecture.